Hello and welcome to episode 1 of Money Anonymous. I'm Kira Jones, financial coach and founder of Financial Intervention Academy. In today's episode, we are going to be answering questions about credit repair, what to do if you're going to be late on your auto payment, and 2 questions about underwater auto loans. These episodes were previously recorded when I was doing Money Monday live. And I wanted to bring these to you as some of our first episodes here of Money Anonymous. So let's jump right in. Hello, I have a good credit score right now and have maintained it almost a year, over 720, but I do not have a credit card as of now. I had maxed it out mostly due to the interest rates, but once I was able to pay it off when it went to collections, I paid it off last October. I've been trying to get another credit card, but have not had any luck with other major companies, unfortunately. So what would you recommend I look into getting to keep my score where it's at, if not getting it even better than where it is at? So off the bat, I'm just curious that this 720 credit score, is that a Vantage score or is that your FICO score? Because if you're going off Credit Karma, it's a Vantage score. And I covered that actually in my little test video last night. Minnie Mouse was gracious enough to help me test this and asked, why she sees different credit scores in the different places. And that's usually because of Credit Karma uses Vantage scoring model, which is not actual FICO models. And the FICO is what the major 3 credit bureaus go off of. And that's what most lenders are going to use to approve or deny you for credit cards. So they tend to run 20 to 40 points lower than your FICO if you're going off your Credit Karma. So you could have a 720 FICO or Credit Karma score is 720, but your FICO score might actually be around 690 something. And that could just be the reason why you're getting denied from these other major companies. So what I would recommend is getting a secured credit card. Anyone with no credit, anyone looking to rebuild from bad credit, I highly recommend secured credit cards. I have done this twice. This most recent time, after a bankruptcy in 2019, I got a card with Open Sky because they did not do a credit check in order to approve me, which kind of makes sense because it's secured with your own money. So I gave them $300. They gave me a credit card with a Visa logo, and my standard rules for credit cards apply. So 15 to 30% of your balance of your available limit is a good balance to carry. But anytime you start carrying more than 30% of your balance, it starts working against your score because you're carrying a high debt load. If you're paying it off every month, that's great. But $300 credit card. So in the first month I made a payment, or I charged something that was about $100. So about 30%. And I paid it off over 2 payments. This was right after my bankruptcy, and my 810 credit score tanked all the way down to a 585. After I got the credit card, the secured credit card, 1 month after bankruptcy, and I made the $100 purchase, paid it off over two payments over 2 months, my score went up to a 696. So that's over 110 points in gain just from getting the secured credit card and using it the way credit cards should be used. And they're just good vehicles for rebuilding credits. Now, if I ever want to get rid of that credit card, yes, I can cash that out and get that deposit back. But these are great vehicles for improving your credit. So know what credit score you're looking at. If you're looking at a Vantage score or your FICO score, and do get a secured credit card. There are some other metrics. Let me see here. So when you're looking at kind of the things that affect your credit, if it's a fact of no credit and you're just getting going, by adding you to someone's credit card that has had a credit card open for 10 plus years, the older, the better. So like grandma adds you to her Elder Beerman card and she's had it for 30 years. Then you open this new secured credit card. So it's only been open a couple months. So you take those 2 credit cards and you average for the 15% of length of credit history. Now it looks like you've got an average credit history of 15 years, when really all you did was get added to your grandma's card and you open up your your secured credit card. And these are 2 huge metrics to get you going in the right direction. Is it better to be 2 days late on a payment or defer it? I haven't missed or been late on a single vehicle payment. I have had it since November of 2022. I will literally be 2 days late, but there's no option for that on my Ford credit. The only option is to defer it by 1 month. There's no fee to defer, but I'd rather defer it if being 2 days late will affect my credit. Well, good news there is that nothing affects your credit until you're 30 days plus late. Most credit cards, most creditors actually have a grace period anywhere from like a couple on up to like 10 days. So more than likely you're still in your grace period, but call. Just call. I mean, it can go so far that you call and let them know ahead of time before you've missed the payment. They're going to be so much more willing to work with you. And, as long as you make that payment, on the 2 days late that you say you're going to be, you won't get the late fee, especially because you called in advance. Or some creditors, you just got to call and have a conversation with them. But more than likely, this is not going to affect your credit. But I would highly recommend that you call first. Okay, I think there's a couple questions that are kind of about this, which is being underwater in your auto loan. So I purchased a car last October. There's still 34,000 left on the loan, but I don't think I'll be able to keep up with the payments. Would it be better to trade it in and purchase a used car? The trade-in value seems to be around 24 to 26,000. A dealer close to me has a 2008 vehicle for about 6,000. So I'd end up with a loan for around 16K, which would be easier to manage, and hopefully the insurance would also be cheaper. Yes, more than likely the insurance would be cheaper on an older, more used car that's not as expensive to insure. So that would give you a break. But you do have to think about the amount that you are deficient by. So, when you're underwater on a loan, that means you owe more on the loan than the car value is actually worth. I'm actually going to skip ahead to the next question because it was very, very similar. How reasonable would it be for me to try and sell my vehicle back to the dealership? I am struggling, have a vehicle that is fully paid off and not in use currently. It would be saving me $500 plus a month not to have this vehicle payment. Is this even a thing? Yes. So I'm going to go back here. So in both of these cases, what you kind of have to do is figure out what you're going to do about that amount that you're deficient by. So when you say that your trade-in value seems to be around 24 to 26K, does that mean that's what the dealership will give you for trade-in? Because more than likely you could sell it yourself for more than that, because obviously when you trade it in, they're going to resell it and they need to make some money off of it too. So they're not going to pay you what the vehicle, like the market value, would be worth for that vehicle. So if you look up the Kelley Blue Book value of your vehicle, and it might say that you're closer to 28 to 30,000. So now your deficiency is only $4,000 to $6,000. And so in the case that honestly, you would be much better to sell this yourself. There's hardly a circumstance where I recommend that you trade in a vehicle to the dealership. Again, they're not going to give you all that vehicle is worth because they still need to flip that and make a little bit of money. So what you would want to do if that's the scenario is try to sell it yourself. But because, the title won't be released until you pay off that full loan, because the bank is whoever financed the vehicle is going to hold the title. So you would draw up a bill of sale with this buyer that you're going to sell it to personally. And that says that, hey, once I get your $28,000, I will then go to my bank. I will secure a personal loan or whatever you're doing. You're contributing the other amount to pay off the loan. And that once you pay it off and you receive the title, you will sign it over to them, the new vehicle owner. The bill of sale, it's like a contract. It's like an agreement. So they will be able to hopefully feel okay that as long as, you're on the up and up with this and that you get the loan. This is honestly one of the hardest spots to be in is underwater on your auto loan. Vehicles are a depreciating asset. So, in thinking of what we can do to literally avoid this situation is you have to put money down on vehicles. Let me see. Most recently I looked up, I think it's about 17.5% of people are underwater in their auto loan, meaning that they owe more than it's worth. So one of the things to do is just jump on Kelley Blue Book and look up the value of your car right now and compare that to what you owe on your loan. So then you can kind of tell how big is the hole. And if it's a newer vehicle, because a lot of the auto market is a little wonky right now, and that, a 2 or 3 year old vehicle might cost the same as a brand new vehicle. But most of the time, before this weird time in the auto industry, 1 to 2 years old means that it's already depreciated 10 to maybe 20% of its value.
to buy a brand new car, it is almost guaranteed that it will depreciate 5 to 10% the second you drive it off the lot. And there's hardly any vehicles that are under brand new vehicles that are under 20 grand. So let's say like, $25,000 for a brand new vehicle. If you can afford to light $2,500 on fire, then you can have the privilege of driving the car off the lot. If you can't afford that, I mean, most time when you get a loan, the second you drive it off the lot, you are now immediately underwater on a new car purchase. It is immediately worth less than what you bought it for, and that immediately puts you in the hole. So, unfortunately, it's difficult when you're trying to get out of a really high monthly payment, because obviously that could free up a big part of your cash flow to start paying down debt and doing other things. So, but at this point, if it's a new enough car and it's nice, then, you might want to think about refinancing. Right now is tough because interest rates are so high. So, but right now, the good goal for you would be to hustle, make extra payments, even $50 a paycheck here and there. You'll start to see that add up. It'll make a significant difference. The more you can pay that principal down earlier in the loan, the bigger the difference it's going to make in the life of the loan. And so once you know kind of the hole that you're in, you just really need to be very diligent about paying it down. And so that way, when the loan does get to a point where you owe about as much as it's worth, hopefully at that time in the future, interest rates have stabilized. And that way it would make sense for you to go and refinance your car for possibly a lower interest rate, but definitely lower monthly payments. And you're more likely to get financing if if you're getting a loan for what the vehicle is actually worth. Here's another thing to consider. So if your auto loan is with a credit union, so it's not financed with the dealership, as in with this case, if you say have your loan through a local credit union, they might be a lot more willing to work with you in this situation. So it's like, hey, I have a buyer that's willing to pay what the vehicle's worth. I'm still going to owe $6,000 on this loan. I'm clearly underwater. Would you be able to give me a personal loan for that amount? So that way I can get out from underneath this vehicle, buy another vehicle with cash, or, maybe you can make do with one vehicle or, no vehicle for a short period of time. Again, this is a really rough situation, but the credit union is going to be more willing to work with you. And especially if you have, say, your mortgage with that same credit union, because, now you're upside down in this major asset, this major depreciating asset. And they don't want you to default or risk the vehicle getting repoed, because, a lot of people wonder if they can voluntarily surrender their vehicle. Yes, that would be better than a repossession in terms of your credit, because in order to get to a repo status, you've got to start missing payments. So 2, 3, 4, up to 6 months of missed payments, more than likely, they're going to begin the repo process. They can do it after your first missed payment. It's not likely that's going to happen. More than likely, it'll be about 3 months to 6 months of no payments before they actually pull the trigger to go and repo your car. So in order to avoid that, yes, it would be better for your credit to surrender the vehicle. You want to do that to whoever the loan servicer is. That's not necessarily the dealership, but that would be better than a repo. Now, again, you're still going to have a deficiency balance, because when they take back possession of that vehicle, they're going to sell it at auction. And so again, that's not even going to be your trade-in value that a dealership would give you. It's going to be substantially less what they sell it at auction for. So you're going to be on the hook for that deficiency balance. Now, I have currently worked with 2 people, and I also used to do legal debt collections, that creditors are now suing over these auto deficiency balances. And so that means they're going to send you a letter from the courts saying that they intend to file a judgment against you for the debt, for the amount that you owe after they auction it off. That deficiency balance on your loan is what's left over, that they might sue you for that. And best case scenario in this, I just want to get this out there because I'm seeing a lot more of it, is if you respond to the letter to the courts, you usually have 30 days to file an answer with the court. You'll want to Google how to file an answer in the state of, and then insert your state. Once you submit that to the court, a court date will be set. Now, the collection agency doesn't want this to go before a judge. They don't want it to incur more fees. They make bank on the people that kind of ignore this. Obviously, if you've had a repo and you're going through financial situations, you're stressed out. You might not be opening your mail. You might not be paying attention. So they win a default judgment. If you simply don't respond in that 30-day time period, then the collection agency will win a default judgment from the court. And that's what begins the process for them to either garnish your wages, levy your bank accounts if you have a substantial amount in savings or checking, or they can put a lien against your property. And at that point, we're talking balance in full. We're not talking about settling. However, if you respond to the court and you file the answer, that collection agency realizes that you're taking notice and they're going to be more willing to work something out with you to avoid it going in front of the judge and getting more fees. In both of the cases, examples that I've worked with this year, they were able to settle their debt for 20%. 20 cents on the dollar. So that's 80% off their debt. And in one case, it was like $10,000. And he said, hey, I've got $2,000. Will you take it to settle this? They said, absolutely. So that would be one way in order to settle a debt. If you're in that situation, if your car's already been repoed, then keep an eye out for this to be the next step that you might get sued for this. But in order to avoid that completely, the best thing that you can do is to pay a down payment. Don't finance your vehicle for more than 3 years, 3 or 4 years maximum. And if you are in the situation where you do have a brand new car, but that payment's just really, really high, I would just work super, super hard to pay that car loan down. When interest rates stabilize and interest rates come down, because we're seeing interest rates upwards of 10 and 12% on auto loans, and that is very, very high, very high. They will come down. The economy will bounce back and those interest rates will come down. And then you want to be in a good position to refinance your auto loan for that lower monthly payment, but you've got to get that balance paid down so you can kind of get the car loan closer to the value of that actual car. Very tough situation this is. Again, reach out to me, DM me. We can schedule a free complimentary 30-minute discovery call, talk about your specific situation. But honestly, this is one of the toughest ones that I see.
All right, that's it for episode 1 of Money Anonymous. If you would like to submit a question to be on a future episode, please fill out the anonymous Google form. The link is in the description below. And as always, this is for educational purposes only. This is not meant to be financial advice because personal finance is just that. It's personal. So if you have any experience with the situations that we discussed today, please contribute to the conversation in the comments below. And because, with more knowledge, we have more options, which means smaller emergencies. Be well, friends.